Welcome to Week 5, Non-Qualified Compensation and Benefits. I am Scott Rowland. You can see my information on the screen. I'm a Carlson School alumni. Been in this business essentially my entire career, so hopefully I'll be able to share some insights and industry knowledge with you through this course, at least in Weeks 5 and 6. The first place to start is we have to start talking about benefit plans. Qualified plans like 401ks or non-qualified plans like some of the plans we're going to explore in more depth this week. Non-qualified plans are, as you can see, plans that go above and beyond normal compensation and normal retirement plans. So a 401k, for example, is a qualified plan. Health insurance, those kinds of benefits are offered by essentially all companies at some form, but this non-qualified plans are above and beyond those for a select group of management or highly compensated employees. They can be based on contributions like a 401k, or they can be meaning that an employee would contribute, or they can be non-contributory on the employee's part where the company's just contributing money. These plans are generally long-term focused, retirement, or some kind of a long-term horizon. And that bottom bullet point, the selective participation of only key management or highly compensated employees, is important. That's a Department of Labor regulation, and that's about as specific as it gets. However, there isn't any direct guidance, but that's because plans like this have some risks that don't exist with qualified plans, and we'll explore that in the next couple of slides. So let's understand, or work to understand, the basics of the tax treatment of these kinds of plans, both for the employer and for the employee. Under a qualified plan, like a 401k, all employer contributions are tax deductible currently when those contributions are made within whatever limits the government has established for those plans. So for example, 401k plan, the maximum contribution is $18,500 in 2016, and that number will change slightly with inflation over the years. Employee contributions are also are deferred for income tax purposes, and taxes are then owed when benefits are paid at the back end when they're taken out, and earnings inside the plan on those contributions by participants are not taxable, and they're also the assets are also not taxable to the corporation. It's actually an off-balance sheet sort of transaction in a qualified plan. If you participate in a 401k or do someday, your employer will write a check to the 401k trustee. That money goes off the books of the company and does not remain as a liability for the corporation. Conversely, on the non-qualified side of the sheet, there are some restrictions on how this all works. Importantly, in the middle there, the employee's treatment is the same as it is in a qualified plan, which is the reason these plans are popular and why they make any sense at all. Because the employee doesn't pay tax until later on when amounts are actually paid out. However, the tax benefits that employers get on the qualified plan side don't exist on the non-qualified. That's the non-qualified, that's the reason for the wording. They're non-tax qualified, at least from the employer's perspective. So employers get no tax deduction up front for any compensation that they are accruing under a plan like this. They only get that deduction when the employee actually receives benefits in the future, and that's when the employee pays tax. Also, further in that bottom right corner there, the employer, if it sets aside assets to finance or pay for these non-qualified plan liabilities, those assets are not tax sheltered unless the asset itself has a tax structure to it. So there's no plan or trust that a company can establish to fund a non-qualified plan that creates a tax advantage directly for the company. So there's also some non-tax issues that we need to be aware of when we're thinking about the differences between qualified and non-qualified plans. So qualified plans are secure from the risk of corporate creditors seizing the assets if there's a bankruptcy. That means that if you're in a 401k or a pension plan and your company goes bankrupt, your money's not at risk as a participant. That money doesn't belong to the corporation anymore. It's legally walled off with a separate entity, the plan itself, and a trust that protect it. Those plans also are subject to the full application of ERISA, which is the Employee Retirement Income Security Act from 1974, which was designed to protect employee participants in plans like this. Part of ERISA, it includes anti-discrimination rules. There's a lot of rules, basically, that the Department of Labor and the IRS place on qualified plans. But in exchange for following all those rules, that money is very safe. And it's always the first place we tell companies to design a plan is a qualified plan because of all those safety issues. Now, there are limits, as I mentioned, in the tax piece on qualified plans. The way the IRS and Treasury and Congress look at the cost, quote unquote, of plans like this, qualified plans cost the Treasury money because there's a tax deduction today for the corporation, which is lost revenue for the government, but there's no corresponding income tax paid today, which would be income for the government. That tax is paid later on when people take their money out of those plans. So there's a timing difference, and that is measured as a cost for the government. So that's why there's limits, and there always likely will be limits on qualified plans because of the cost, or at least the perceived cost to the government. Now, on the non-qualified plan side, in exchange for being able to offer these plans, and by the way, there's no limit on the dollar amounts or a volume of benefits that can be provided from non-qualified plans. It just has to be reasonable compensation. Other than that, no dollar limits, but there's some other restrictions and rules. So first of all, there's a risk. The assets are subject to creditors of the company if the company goes bankrupt. In layman's terms, that means if somebody has money in a non-qualified plan as an employee, they might not get all their money back if that employer goes bankrupt. Now, the reason that is the restriction is because that's what the IRS says, that's the risk that must exist. It's called the substantial risk of forfeiture in legal terms. That risk has to exist in order to allow the pre-tax nature of the plan for the employees. And because of that risk, then other government agencies get involved and they say, well, you know what, these plans are not going to be subject to most of ERISA because it's only for a select group of key people. And the reason it has to, and you see that bottom right, these plans must discriminate for only that select group of management or highly paid employees because of the bankruptcy risk. So the logic there is, you don't want rank and file employees to be subject to losing their money if the business goes bankrupt because rank and file employees are not perceived by the government, and rightly so, to be the ones responsible for driving a company into bankruptcy. On the other hand, government says, well, if you're the key people, the C-level folks and the managers of the business, and you drive the place into bankruptcy, then you can bear that risk and maybe not get all your money. That's the logic. That's the reason those structures exist, and that's why these plans are specialized, only offered in certain situations and for a smaller group of key people, not the whole company. Okay, so I already described ERISA for you, and just to put it on one page, again, the Employee Retirement Income Security Act of 1974. Yes, 1974. Yes, I was alive then. No, I was not in this business. It does apply to both qualified and non-qualified plans. So if you ever run into a situation where someone tells you that a non-qualified plan is not covered by ERISA, that is incorrect. However, many parts of ERISA don't apply to non-qualified plans. That's the bottom bullet point there. There's an exemption from major parts of the rules. The basic ones being the fiduciary and funding rules. A non-qualified plan is not funded in the same sense that a qualified plan is, and it doesn't have the same fiduciary rules and restrictions for the plan sponsoring company. However, on the non-qualified plan side, there is a reporting requirement to the Department of Labor and a few other requirements, mainly that are involved in the plan document. The Department of Labor reporting, DOL, is just a one-time reporting for non-qualified plans, one time at the adoption of the plan, not an annual return. Some of you may be familiar, there's a tax form called the 5500. It's essentially a tax return for a plan, like a 401k plan. Those qualified plans have to report annually, non-qualified plans do not. Okay, so we've talked a little bit about the basics, kind of behind the scenes for non-qualified plans. So what companies use these plans and how do they get used and why? That's what we'll start diving into now. We're going to talk about some nonprofit things a little bit later, but for now, let's focus on for-profit companies. And the reality is any kind of a for-profit company can offer a non-qualified plan. And the corporate structure of that business doesn't affect the benefits of a plan, a non-qualified plan, for the key employees. So whether it's a C Corp, which pays its own taxes, or an S Corp, or an LLC, or a partnership, or some other kind of entity that are known as pass-throughs, where the tax impact of the business is passed through directly to its owners, there's no problem in any of those corporate structures for key employees. Now, there's a few places where these kinds of plans are really not used, and that is in startups where there's not a lot of cash necessarily or no earnings. So when I say for-profit, any kind of for-profit company can offer a plan, they can, but it's usually for-profit companies that are actually making a profit. That's a good starting point. And then service firms, doctors and lawyers, especially doctors and lawyers, are not great. They tend to be more like partnerships, and they're not great prospects for plans like this. They do get used sometimes in very unique situations, but the partnerships are tough because essentially everybody that's a partner has a piece of the tax impact of the business, and unless everybody gets treated equally, nothing gets agreed on. So that's the reason that those kinds of entities don't use these plans as much. And that's kind of the segue to the bottom bullet point, which is that majority owners of any of these kinds of businesses, whether C Corp, S Corp, LLC, doesn't matter, there are some special issues and significant tax inefficiencies for majority owners in any kind of a business. So let me give you an example. Even if you own a C corporation, let's say you own 100% of that business. That C corporation has its own tax return that pays tax, but if you own the whole business, you also therefore own the whole tax effect. So even if you try to create a tax advantage plan for yourself using a non-qualified plan as an employee, the effect of that is to, remember I talked about the timing difference in the tax deduction for non-qualified plans. The company doesn't get a deduction up front. It only gets the tax deduction when the employee pays tax later. So say you're this C Corp owner and you want to defer $10,000 extra. You don't want to pay tax on that because you're tired of a big tax bill. Well, you could do that on your personal W-2 and as the employee, but now the business is going to lose the $10,000 tax deduction because the amount you defer is not deductible as compensation anymore. So even though you personally deferred to the $10,000 and didn't pay income tax on your W-2, now your business has $10,000 more of income, and so the tax effect gets washed out because you're the owner of both sides of the transaction. That's why this works for key employees who are not majority or not owners, and that's why it doesn't work very well at all for majority owners because of the tax issue. Another way to think of that is the pass-through. An S Corp, LLC, most businesses are S Corps or LLCs that are pass-through entities where the business itself doesn't file a tax return. So it's much more straightforward there. You don't have to look at two separate tax impact. As the owner of a S Corp, you try to defer your own income, but it immediately shows up as a reduced expense that therefore reduces your tax deduction. So it's very straightforward. And that's why a lot of owners don't do these plans for themselves because of the tax inefficiency. But smart owners think about, how can this benefit my key employees and therefore indirectly benefit me, the owner, by helping me keep my key people around and or driving the value of the business higher. Here we've got 4 names of different kinds of non-qualified plans. Especially the first one, the SERP, the Supplemental Executive, is the E, retirement plan. Everybody will have their own definition of what that is. I've kind of mentioned earlier in the presentation about contributory plans or non-contributory. Most plans in this supplemental retirement area are plans where the company is providing the dollars for the benefit. That's how we think of it, and that's how it's easiest to kind of separate these ideas, I think. So any kind of a SERP or supplemental retirement plan is a plan for this purpose where the company is providing the dollars, not the employee. Next one then, voluntary deferral plans. That's the opposite. That's a plan that sort of can sit right on top of the 401k and basically take the limit away. So an employee can put their 18,000 or whatever the number is into the 401k, or whatever limit the government is stopping them at, because there are some other rules, discrimination testing and other things for qualified plans. So many times employees are not able to put the full 18,000 or more into a 401k. So say they're cut off at 6% of pay, and that may only equal, $12,000 or $6,000 or whatever the number is. A non-qualified plan can sit right next to it and accept additional deferrals above and beyond what the 401k can. Those plans are very, very popular in corporate America. I would say roughly 75% of companies in corporate America, and I'm not just thinking Fortune 1000 now, I'm thinking all of corporate America, have these kinds of plans. And it's because of the limits on the 401k plans. These plans are popular. Phantom stock plans and long-term incentive plans, those plans oftentimes get mashed together in a conversation and a plan design analysis. The idea with all that long-term incentive plan, whether you call it phantom stock or not, the idea is to create a benefit over the long term, however the company defines that, to reward key employees for creating growth generally in business value. So sort of like a stock, but mainly these are done by private companies that don't issue stock to employees or to the public and don't want to issue stock for all sorts of reasons. And we'll talk about stock plans more in a while. But the concept is long-term reward for growth in value of the business. And owners like this concept because if the business doesn't grow, if the key employees aren't successful in driving growth, then there's no value to pay out. So it's not sort of an entitlement benefit. Participants aren't receiving dollars that they didn't earn, and owners are much more happy to pay for a business that is growing and share part of that than to just give away, quote unquote, give away more money for compensation without results. While we're going to spend the most of the time discussing Section 409A, deferred compensation plans that you see on the bottom bullet point, there are some other rules and regulations and tax code sections that get involved in this area. Section 419 plans. Section 419 is a section of the code that governs things called welfare benefits. In layman's terms, essentially welfare benefits are all other kinds of benefit plans except for retirement. So they are severance pay plans, long-term disability, insurance plans of all types, life, disability, health insurance, all the vacation pay, all those kinds of plans are welfare benefit plans subject to the rules and regulations of Section 419. Some providers in the non-qualified marketplace have tried to use life insurance benefits and other types of benefits in in a way to skirt some of the rules around 457 or 409A and provide deferred compensation in a disguise, basically, to make it more attractive, supposedly. My advice to all my clients and to you, if you get into this world at all, is to run away from those situations. Section 419 is clearly designed only for welfare benefits, and you should not, no one should be sort of bastardizing the rules to try to get around things. There's plenty set of rules and clear expectations for deferred compensation. Section 457, this is the nonprofit part of the discussion for now. Section 457 governs deferred compensation and retirement plans for nonprofit entities. There are specific rules, regulations, limitations, and those limitations are actually a little more stringent on nonprofits than they are on for-profit companies. And I think the legislative logic, if you want to use those words together, is that nonprofits already have a tax shelter built into them. The entity itself is a tax shelter, does not pay tax. So the Congress and Treasury agrees do not want people, key employees at nonprofits, sort of looting and pillaging those nonprofits with excessive compensation and retirement plans, knowing that the entity itself is not paying tax. So there's limits that are similar to, and the rules are actually more stringent than qualified plan like 401k limits on 457 plans. There's one section of 457, 457 small f, that allows for more creativity, and it's fraught with risk. That doesn't mean it doesn't get used by nonprofits, but it does create extra risks, and probably could be the source of almost a whole another week's course. So we won't explore that further right now. Section 409A, all of this non-qualified deferred compensation stuff for-profit companies that we've been talking about and will continue to talk about in this course are governed by Section 409A. That tax code section actually came to be law at the beginning of 2005. President George W. Bush signed that law. However, the regulations weren't even drafted until 2007 and were not finalized until January 1st, 2009. So, which means it's no longer a new law, and the regulations aren't new anymore either, even though I still find today, once in a while, I find a company that really hasn't paid attention in the years since 2009, and they might not be in compliance. Importantly, those regulations laid down sort of the white lines on the road, if you want to think of the highway. There's several lanes in the road between the edges where you can run your 409A deferred compensation plan and be completely compliant. However, it is quite easy to the uninitiated and not paying attention type of folks to accidentally administer a plan out of compliance, even if its documentation and its communication is clearly in compliance. So it's not just a issue to think about when the plan is adopted. It's an issue that has to be considered on an ongoing basis as part of plan administration, because the rules are such that it can be easy to make a wrong decision administratively and potentially ruin the tax deferred nature of the plan for everyone in the plan. I believe this is time for an intermission. Welcome back from intermission. So, non-qualified plans, the first phase of the course here we've talked about is the design of a plan. So once a company has decided on whether it's going to do something like profit sharing or long-term incentive plan based on the growth and the value of the business, or those are the most popular forms of design, by the way, other than the voluntary deferral option for key employees to go beyond the 401k limit. Once a company has decided on that structure for the plan, then it needs to figure out how it wants to pay for the promises being made in that plan. So to pay for those promises, if you recall earlier, I spoke about how qualified plans, the reason they're so safe and recommended first is because the assets really don't belong to the company anymore once they go into the plan. They go off the balance sheet, not subject to any more corporate risk. Remember now, non-qualified plans can't be funded in that same way. So that first bullet point, they are legally unfunded. It really means in that second bullet point, an unfunded promise to pay compensation in the future. So there's a contract, the plan and the plan agreements lay out the contract between the employee and the employer, but there's no legal way to separate assets from the business and get them away from potential creditors to support a non-qualified plan. So that's why we talk about financing and not funding, and it's informal funding is another way people think about this. And the concepts here are constructive receipt and substantial risk of forfeiture. Those are both legal concepts. The substantial risk of forfeiture, if you remember, is the risk of not getting all your money out of a non-qualified plan if your for-profit company goes bankrupt. That substantial risk of forfeiture must exist in order for you to not, as a participant, have to pay tax on the money until it's paid to you. Once it's paid to you, then you owe tax, and then you are in constructive receipt. That's the other legal term. So once you constructively receive the income, you owe tax on it. Now the risk in legally funding a plan or moving the money away from creditors is that you could cause constructive receipt and therefore taxation before the benefits are actually paid out. And that's a bad result that nobody wants to have happen, and that's why we are very careful when structuring plans like this, and you all would need to be as well, about how to finance a non-qualified plan. Needs to be separate funding if the company wants it to be. And I would say this to you. The voluntary deferral plans where people are putting their own salary or bonus away, they're leaving it in the company to be paid later with interest, those plans are almost always funded 100%. So if you as a participant tell the company, I'm doing my 401k, but I also want to defer another $10,000 into this non-qualified plan, those companies are generally then taking the $10,000 and buying some asset. We'll talk about the different assets that get used, but they buy some asset that they keep on the books, but they keep it on the books and sort of put it in a different pocket on the balance sheet to use just to pay those benefits back. So they're matching assets and liabilities. That's really what non-qualified plan financing comes down to, is matching assets and liabilities. On the other side of the plan design coin, if it's a plan where the company's providing money, I used the word, that acronym SERP, to describe company money funded plans. If that's the design, lots of those plans get funded, but not probably at 100% level. And I'll tell you why. If it's company money that is being used to drive the value of the benefit, employees are not contributing then, and that benefit is not currently tax deductible, and the funding's not currently tax deductible to the employer, but it's deductible in the future. So the discussion you have with a finance person, a CFO or somebody at a company, is to say, well, yes, you could fund 100% of the SERP liability, but 40% or whatever your assumed corporate tax rate is, 35% perhaps, 35 or 40% of that liability is actually your future tax deduction. Do you really want to finance your future tax deduction as part of the funding? You can, absolutely. But most CFOs say, yeah, that makes sense. Let's just, let's finance the after-tax piece, and we'll make the rest of it up at the back end when we pay out the benefits and get the tax deduction. So that's the logic that goes into at least the financing discussion for non-qualified plans. Next couple slides will take it even further. But before we go all the way to the financing vehicles and different types of assets that get used, there's another question as well, the security issue. Remember, I mentioned qualified plans, 401ks, they're off the balance sheet. They have the ultimate security from bankruptcy because they don't belong to the company anymore once the companies made the contribution to the plan. Non-qualified plans, again, they remain a liability of the corporation. Any assets that are set up to finance it are also assets of the corporation until benefits are paid. So lots of companies think about, well, I mentioned the pocket on the balance sheet that they might think about for putting assets in. Sometimes the companies go further and create some structure for that pocket. Many times they don't, though, and that's the none. They don't do anything additionally to create security for their non-qualified plan. But that next bullet point, the grantor or the rabbi trust, quote unquote, is the most common vehicle used by companies in America to create a fence around that pocket or some extra security around that money that they're setting aside to finance a non-qualified plan. The nickname rabbi trust, you can't make this stuff up, folks. A congregation did a plan like this in 1983, I believe, for their rabbi. And that was the first grantor trust established for plans like this. And there you go. Truth is stranger than fiction, and I'm not lying. You can Google it. Anyways, that's the nickname the industry has given it, but the legal term, if you talk to a lawyer who doesn't know the nickname of it, it's a grantor trust. The company is the grantor of the trust, but the company also retains ownership of all of the accounting and tax impact of anything in that grantor trust. So that's the most common vehicle, and what that does, by adding a trust and then putting your financing assets in the trust instead of just having them on the books, is that it adds the little Lego man you can see on the screen here. It adds a third-party trustee to the equation in case there's a dispute, or if the company gets sold and the new buyers don't want to pay, or any kind of a dispute short of bankruptcy. That trustee can step in for the benefit of participants and protect them to make sure they get the money owed to them out of the plan, and that has been deposited to the trust. So that's the extra layer of security. It's not a very expensive solution because those trustees don't do a lot other than hold assets until there's some kind of an issue. It's not a qualified plan trust, and so they're not filing tax returns, all that sort of stuff. The next bullet there, the secular trust. The industry that I'm in, I'm afraid, people, is not terribly creative when it comes to names. So somebody thought, well, if we're going to nickname the other one a rabbi trust, how about if we make this kind of trust secular, non-religious? Whatever. Anyways, the idea with a secular trust is supposed to be descriptive. Those trusts, and they very rarely get used anymore at all. So I'm going to describe it for you, and then we're going to move on. But the secular trust idea is to actually create a trust that goes off of the balance sheet of the company and is probably in the name of the participant, but it's removed from the business. So as you can imagine, if you've been paying attention, what does that do? Yes, you're right. Moving the dollars in a trust off of the balance sheet creates immediate taxation for the employee participants in the plan. The only way those situations come up is when a company is in a highly regulated business or is very, very worried about regulatory overreach and really needs to get some money to people, because those companies then generally also gross up the benefits. They add money to the benefit to pay the tax up front for the employees. As you can imagine, that does not happen in the Fortune 1000 anymore because the optics in your proxy for your shareholders look terrible, and private companies don't do it much either. So it's very rare these days. Probably got talked about more in the 1980s and 1990s, but it's still something that's out there, and people are still trying to find the holy grail of moving money off of the books and not causing taxation. And that's where other ideas come in. None of them work. I'm going to be really honest with you. Somebody might say to you they work, but the thing I always tell clients is, look, if it takes 6 inches of legal opinions, 6 inches thick of legal opinions to justify your tax structure of your non-qualified plan, is that really the place you want to be taking that much risk in your business? You probably have a lot of risk selling or making widgets. I don't think the non-qualified plan is the place to add that level of risk. So that's what we do. Okay. So more detail on the rabbi trust. Now, I mentioned, where the nickname originated. Now, and I gave you some description. Here's more detail. Funds are held in a trust with an independent trustee. And this is what really gives it the teeth. It's a bank or a trust company or something like that. It's not the owner of the business, importantly. It's not the CFO. It's a third party. Otherwise, if a client tells me they want to be the trustee, then I say, don't bother doing the trust. The only reason to do the trust is to have the independent third party. Otherwise, it's just paper and it doesn't really matter. And again, remember, the rabbi trust is a grant. The company's the grantor, but everything remains on the books. So the second bullet point's an important one. It does not remove the assets from claims if there's a corporate insolvency or bankruptcy. And this is why it doesn't trigger taxation. And in fact, in 1996, the IRS got tired of answering private letter rulings from people, so they issued a model trust document, essentially a draft document from the IRS that's approved, and companies can use that draft with no risk of triggering tax for their plans and no need to get a private letter ruling. The companies are even going further, and trust companies are going further and adding some features to the model trust. Nobody's worried about that causing any tax risk because they're not doing anything that changes the basic nature of the bankruptcy structure. So that bottom bullet point, again, the desired outcome is that the participants should be taxed when they get the money upon constructive receipt. We don't want to trigger constructive receipt before they get their money, and that's why a rabbi trust is the safest way. It's been blessed by the IRS and doesn't require any extra hoops. Very efficient, very straightforward, and it actually works to solve the bulk of the problem that's trying to be solved in this situation. Okay, pressing on. Here we are in week 5, continuing. Non-qualified plan financing. Here's the different things companies think about in increasing order of commonality, except for none. Lots of plans in this space are not funded, but those are generally plans, for example, phantom stock or long-term incentive plans that only pay out if the company is sold. So, an example, in case a company wants to protect its key people, if the owner is going to sell, but the owner doesn't want to give people real stock for all sorts of other reasons, then a plan that pays just upon a change in control. We call that a change in control plan. Those plans aren't funded in advance because they only pay out if there's a sale, and when there's a sale of a business, there's money sort of flying around everywhere, and the owner can easily finance the plan at that time. So those are the plans that don't get funded at all, generally. Other plans I mentioned earlier that, voluntary deferral plans where people are putting their own money in, that they could have taken home as salary or bonus. Those plans do get funded generally at 100%. And then other plans that involve company money are somewhere in between the 0 and 100% funding amount, depending on the company's cash flow needs. Many times we'll work with a company and they start a plan anticipating they're going to have liabilities in the future, but they don't have a big liability to start with, so they don't finance it right away. But we make sure we stay in touch and keep reviewing the size of the liability. And when it gets to a point that the CFO says, yeah, we should probably start funding this, that's when they think about it. So there's no requirements to do anything in terms of financing. It's a corporate promise that has to be paid upon the terms of the plan, and it's simply good business to set money aside to pay for that liability in the future. So other than none, the classes of assets, indemnity insurance is a really interesting discussion. It doesn't hardly get used anymore. The concept is insurance for the participant that if the company doesn't pay you, the insurance company will pay you. Well, that sounds great in reality, but the extra reality is good luck finding an insurance company that's willing to take on that obligation for maybe more than a year. So it turns into an annual transaction that's probably much more expensive than it's worth. So indemnity insurance, it gets brought up in discussions, but then it gets put away pretty quickly. Annuities do get used sometimes by companies to finance plans. Generally, they get used to finance retiree benefits that are promised to pay for life. If a company says, well, we don't want to be at risk for having to pay this person for 35 years if they're going to live to 100 and they leave at 65, can't we just lock up some money and buy an annuity and let the insurance company take that risk? Yes, you can. And in an immediate annuity situation like that, companies get the same kind of tax structure with a small amount of tax benefit that an individual would get in that transaction. But on an ongoing basis, for current employees, as the liability is accruing during their working years, annuities do not provide a tax shelter rate of return to a corporate owner. So deferred annuities that don't pay out until later do not provide a tax shelter. And I'm not really aware of any companies using a deferred annuity to fund a plan like this. Those kind of companies would use mutual funds instead, and or a mix of mutual funds and corporate-owned life insurance. COLI is the acronym for corporate-owned life insurance. Mutual funds and COLI are the two most commonly used asset classes to finance non-qualified plans. The mutual funds tend to be structured with an eye towards minimizing taxable income because, again, even if it's in a rabbi trust, there's no tax shelter provided by the non-qualified plan or the trust. So the asset itself needs to have a tax shelter if it has any tax benefit. And as you know, if you own mutual funds on your own, there's no tax benefit other than you don't pay tax on gains until you sell the shares of your fund. But there could be income that's spun off and realized capital gains that the fund pays out to you each year that create tax. Corporation pays tax on mutual funds the exact same way. So why are we talking then about corporate-owned life insurance? Well, COLI has a tax benefit in kind of two forms, and this is the reason, it's the only reason companies generally think about using it. Companies use corporate-owned life insurance to provide both the death benefit from the insurance. It's life insurance, so there's a death benefit on each insured participant that the company would receive if that person died, and those death proceeds are tax-free. And we're going to talk more about these details. But then the cash values inside the policy also grow tax-deferred. This is because that's the tax treatment for life insurance under the tax rules, not because it's related to a non-qualified plan. Continuing on the corporate-owned life insurance COLI theme here, again, pretty self-descriptive, but it's insurance that's owned by the company, insuring the lives of key employees, and generally it's the key employees that are eligible for whatever non-qualified plan we're trying to finance. And the company is not just the owner, but the company is also the beneficiary of that COLI. So that when if those key employees die while they're still working, there's an element of key person insurance, which is that second bullet point, so the company gets some tax-free money from death proceeds that it can use to both pay benefits and or help replace the cost of losing a key employee. But then it also generates tax-deferred cash value, and we'll get into that more. But the second bullet point, the non-qualified benefits by self-funding or just the key person insurance is a big element of corporate-owned life insurance. That death benefit, so even in a partnership, for example, where they don't have a non-qualified plan, they very likely will use some life insurance. Each partner might buy a policy on the other one, and if one partner dies, the other partner would then get the death proceeds and could use those death proceeds to buy out that partner's spouse or beneficiaries or the value of the business, and then not have to sell the business or figure out how to generate liquidity to make that buyout happen. So lots of independent, small, mid-sized business owners, privately held companies, have life insurance in place for those buy-sell arrangements, to transfer stock or those kinds of things. It doesn't necessarily mean there's a non-qualified plan that's being financed with it either. So if you work with companies and find that situation, there's multiple uses for corporate-owned life insurance, especially the death benefit piece of that policy. To continue on, the benefits and values, the cash values, are very useful for financing non-qualified plans. Companies pay the premiums. And sometimes people think about, well, if I pay a premium for an insurance benefit as a company, I should get a tax deduction for that. Well, that might be the case for health insurance because it's a welfare benefit, and it's the case for company-provided disability and other benefits. Not the case for COLI because this is not a welfare plan, remember. This is a corporate asset that might be used to finance a non-qualified plan, but just buying an asset doesn't create an immediate tax deduction for a company. So think of it this way. If the company bought a mutual fund, would you expect the company to be able to deduct the value of that mutual fund purchase? No, it's a balance sheet transaction. If they bought $10,000 worth of mutual funds, they now have $10,000 less cash, but now they have $10,000 of mutual fund asset. There's no impact on the income statement. It's the same transaction with COLI. If they pay a $10,000, even though it's a premium, they pay a $10,000 premium to a life insurance company for a COLI policy, they don't deduct the $10,000, and then whatever cash value results from that $10,000 premium payment, they put that on the books as an asset. Again, it's a balance sheet transaction, not tax deductible at all. So that bottom point is, if policies are properly structured and purchased as COLI, again, tax-deferred cash value growth, so the premiums turn into cash values because these policies are not bought the same way you and I buy. They're not term insurance for sure, and they're probably not even bought the way you and I will buy insurance for our families in a permanent form with some cash value. These policies, when companies buy them, if they're properly structured, are really sort of turned on their head. And by that, I mean, what we do is we work with a company to say, okay, you've got X amount of liabilities you're trying to finance. Let's say it's $100,000. How much cash value do you want to accrue in the insurance to finance that $100,000? So we do this in the back way and say, how much asset do you want to build, and therefore how much premium do you need to pay under the maximum allowed rules from the IRS. There are rules that to keep insurance taxed, as you see in that bottom bullet point, you can't buy $1 of insurance and put $1 of premium into it, and because you don't really have insurance anymore. Now you just have a deposit account. So, if you're going to have death benefit, you have to have a certain amount of death benefit above and beyond any cash value. There has to be some real insurance, and that's what the IRS structures. Every company builds its products to comply with that rule, but you can go all the way up, right to that rule, as long as you don't go over it, and maximize the amount of cash value in the policies to make it grow as fast as possible. And that's the way companies buy life insurance for this reason. So they don't really care, or at least they don't set up the death benefit up front. The death benefits are what they are based on whatever asset they're trying to accrue and whatever premiums required to do that. So kind of in summary, term insurance is the most basic form of life insurance there is. You pay a premium and you have X amount of death benefit for a period of time, usually a year. Corporate-owned life insurance generally is about the opposite. You buy the smallest amount of death benefit that the IRS will allow you to buy in order to grow cash value inside the policy, tax deferred, as fast as possible, knowing that cash value can then be used to pay out benefits from the non-qualified plan later on. A little more on COLI. I did mention that these policies have to be structured properly and you have to comply with some rules. These are the rules. The insured must receive notice and consent of the company's intent to buy life insurance on their life, and they have to qualify. A company can't just buy insurance on all of its employees. So the employees must fit in one of these categories to be eligible to be insured. Literally any employee could be insured under the first bullet point, but they have to be an employee at death, or they can only be gone from employment for 12 months. And the reality is most employees don't die while they're at work. So most companies don't try to use that approach because they would be buying insurance that would no longer be eligible once those people had been gone for 12 months from employment. So that's not the criteria that most companies use. It's one of the other three. It's generally the making more than $100,000, or top 5 officers or owners, members of the board of director. Or the safe harbor then is that bottom bullet point, the top 1/3 of the company. So 30%. If a company doesn't try to insure with COLI more than 30% of its employees, and it would be the top 30%, then there's no problem in terms of what that number of people ultimately turns out to, as long as it fits in one of these rules. There is an annual form that's an attachment to the employer's tax return. It doesn't create any tax, but all it does is it alerts the IRS to the fact that the employer has purchased corporate-owned life insurance, and the employer has to reply with a couple of data points of how many people are insured and how much death benefits involved, and then the employer has to answer, have these people received notice and consented to the fact that they are being insured. Every reputable company in the COLI marketplace now, and I mean life insurance company now, the providers or manufacturers of the product, they include that notice and consent form right in the application process, so that as employees are signing the required paperwork, they're getting that form and they get a copy of it. So there's no more days of like Walmart back in the 90s. Here's a little war story for you. Walmart in the 90s decided that it would be a great idea to insure all of its people, including the 73-year-old greeters, because they wouldn't have to pay premiums for very long because people would die and they could just make money. Well, they got sued, and as the result of some of those kinds of transactions, that's why we have this rule that you see in front of you and the reporting each year from the IRS at this point. This did not exist before. I believe these rules came into place in 2006. So that's a little bit of background. But corporate life insurance is very common. And like I said, actually probably most common in conjunction with another asset. So the death benefit of the insurance and some of the cash value can be great, but life insurance is not a great short-term transaction for companies, so a lot of them will supplement the financing of the non-qualified plan with mutual funds for the short-term portion of the liability. I'm going to end up saying some of this twice, but that's part of the reason I did it before this slide came up, because it's important to hear this stuff. And corporate-owned life insurance isn't necessarily intuitive for people that aren't familiar with it. So again, these products are structured very differently. Like I said, you sort of turn the product on its head. It's still life insurance, and it's still individual life insurance on each person, but it's very different than individual retail insurance. It grows cash value much faster and does not have a focus on providing large amounts of death benefit. It also pays the people who sell the products differently. When you buy term insurance on your own, the agent or representative that sells you that term insurance might get half or more than half of that first premium as a commission. It's basically the reward for finding you as a buyer and getting you signed up as a policyholder. Insurance companies don't worry about very many people dying in the first year of their term insurance, so that's why they can afford to pay that. After that first year, however, term insurance pays almost nothing to the person who sold the policy, and that's when the insurance company makes its money to cover its future costs for term insurance. And frankly, term insurance almost never, well, I shouldn't say almost never, but very infrequently pays out because most people let it go. They stop paying the premiums before they ever die. So it's a big money maker for life insurance companies. These products, COLI, is all permanent insurance, not term, and it has cash values, and the design is such that those products are going to be on the books for a long, long time. So those carriers that are really competitive and smart in this marketplace, it's actually a fairly small number of those companies that really understand this, and these products are priced for the long haul. So they're not expecting companies to get rid of their policies and make money on that transaction that way. They have to make it all the way along. So what that means is the representatives, the brokers that sell those products, get paid much less up front for selling those products than you would a regular term insurance or other life insurance product. But there's ongoing compensation from the insurance to the broker because there's a long-term service element built into the promise. You know, the plans are a long-term retirement or compensation plan. The financing then, the corporate-owned life insurance, is also a long-term transaction. And insurance companies, and frankly, the buyers of COLI, the companies that buy it, understand that the people providing the service still need to get paid over time. So regular life insurance is much more of a front-end loaded compensation transaction for brokers. COLI, corporate-owned life insurance, is a much longer term and not all loaded up front transaction. And again, the bottom bullet point, I've said it a couple of times, it's a long-term finance tool. So here's the way, if you were the CFO of a prospective company and I was talking to you, I would tell you this. First, we're going to design the plan, and then we're going to do some financial modeling, and we're going to figure out with you, not for you, with you, what the expected liabilities and cash flows look like from that plan. And then we will help you finance those liabilities in the most efficient way. Generally, when plans have liabilities in the first 5 to 10 years, I say, you know what, let's finance that first 5 to 10 years worth of liabilities with something other than insurance. Because putting money into an insurance policy, even a really efficient COLI policy, it still takes time for those policies to really show long-term value. And 5 to 10 years generally isn't enough. So let's fund those pieces of the assets with mutual funds. And the longer term liabilities, let's fund those with COLI. And in the meantime, we'll always have the COLI death benefit if somebody dies at any point, even in the first 10 years. So that's the structure and strategy that goes into figuring out how this works. Of course, there are folks in the industry who just run around selling COLI because it's cool. And there's other folks who run around selling mutual funds because they're easy to understand. Neither one of them is the answer in and of itself. A combination, I think, is usually best for most companies, and that's how we come at it. Okay, one last slide here in week 5. After I'm done with this slide, there's another intermission page, but you can flip right over it. But I wanted to make sure you know that at the last page of week 5 here, there's contact information for me, my email, phone number. I'm on LinkedIn. So if you have questions, I know Professor Clark, we're going to have the discussion board as well, but feel free to email or call me with direct questions. I'm happy to be a part of that process and help you gain understanding about this stuff. So back to this slide then. Remember now, we've been talking about non-qualified deferred compensation plans. Those are not welfare benefit plans. They're retirement. There's a division. It's retirement plans and welfare benefit plans. So as I mentioned earlier, you can see, welfare benefit plans include long-term disability, long-term care, actual life insurance plans that provide life insurance benefits directly to employees. Not a COLI thing where the company's owning the insurance as an asset, just a life insurance plan. A lot of companies will have a plan that says, if you're an employee here, well, we're going to buy a group life insurance policy and everybody gets a benefit of 1 times their salary. That's your company life insurance benefit. It's generally term insurance and it goes away when you leave employment. That's a life insurance benefit. That's not a COLI transaction. Welfare benefits are usually tax deductible for the sponsoring company when they're provided as a benefit, and so that's the basic structure. Now, I mentioned earlier, I don't know if you remember the slide with the 457 and the 419 and the 409A. Well, 419, remember, is the welfare plan section of tax rules. Sometimes folks in the insurance industry will get really creative and try to use, you can see in this middle of this page, welfare benefits are often tax deductible. They will try to use that welfare benefit tax deduction to create some sort of a long-term value out of a welfare plan so they can get the company a tax deduction today and provide some kind of a long-term benefit to employees. Well, I hate to tell you, actually I don't hate to tell you, I need to tell you, if it looks like a retirement plan and walks like a retirement plan and talks like a retirement plan, it is a retirement plan. So even if you call it a life insurance plan that has a big terminal value at the back end, that's a lot of words to get around the idea that it's a retirement plan. But the bottom bullet point is very important. Welfare plans should not be used to directly provide retirement benefits. The IRS doesn't win a lot of cases in tax court, but they win 419 cases where people are being abusive and trying to get a tax deduction today for something the employees aren't paying tax on later, until later. So that's just a word to the wise and caution, and you can see hey, there's lots of different competing thoughts and tax code sections and regulations. That's why this is an intriguing field and one that I've enjoyed a career in. Hopefully this has been informative for you, and I look forward to speaking to you again for week 6. This is the end of the week 5 presentation. Again, in a couple slides, contact information for me. Feel free to shoot along questions. Thank you. Here's the info.